Thanks, Neil.
Good afternoon, everybody, and welcome to all our speakers and our delegates who have joined us for the first Windaba 2020 webinar. I'm Neil Piper, the Head of Content for Messi Frankfurt, South Africa, and I will be one of the hosts today, and I trust you'll find the webinar engaging and most thought-provoking. The webinar will be addressing the very topical and important topic of the role of wind power in South Africa's economic recovery plan. We have a full session today, and I have lined up a panel of great speakers who will share their thoughts on the subject matter. So on that note, I'm going to introduce you to the various speakers. First up, we've got Ntombi. She's the CEO of South African Wind Energy Association. We've got Emerson Clark, the Director of Growth and Partnerships for the Global Wind Energy Council. We've got Grubey Steyn. He's the Managing Director of Meridian Economics. Marabini Rapeli. He is the CEO of Holsani Limited. And finally, Dr. Tobias Bischoff-Nims, the Head of Department Business Development at Enetrag. Welcome to you all, and thank you so much for your efforts in preparing for today. The agenda for today, we're going to have a short welcome by Ntombi. We're going into two speaker sessions, first one by Emerson, then we're going into a speaker session by Grubey. Then we're going to ask you a few polling questions. This is when we like to get the audience involved. So please get engaged. And then another speaker session by Marabini Rapulu. And then last but not least, the speaker session hosted by Dr. Tobias Bischoff-Nims. And then right at the end, we're going to have a Q&A, which is hosted by Ntombi. So I just wanted to do a short introduction to the webinar. And it really is about Windaba Conference and Exhibition, which has firmly established itself as the must-attend event for the wind energy stakeholders active on the African continent. The next Windaba will be the 10th annual Windaba, which is hosted by the South African Wind Energy Association, SOWEA, and in proud partnership with the Global Wind Energy Council. In Messi Frankfurt, we're the third largest trade fair company in the world with an established operation in South Africa with over 8 trade and consumer fairs. And we're very proud to be managing and working with SOWEA on this conference and the event. I'd also like to thank our partners and our media partners for the webinar series, Engineering News. Thank you very, very much. I would like to now welcome and introduce Ntombi.
Thank you, Neil. Good afternoon, everyone. I'd just like to thank you for joining us this afternoon, especially for this important discussion considering the global pandemic situation that we find ourselves in. While we are dealing with the crisis, we have, of course, need to try to think about beyond the crisis. What is it that we need to do as an economy? And the reason for this topic then is for us as a sector, as a wind sector in particular, to discuss what sort of role as a sector we're going to play in the post-COVID-19 economic recovery. And for us, it's a very important topic. And like Neil has said, this is our first webinar in a series that we're planning to have. We will have monthly webinars on different topics, and we will continue publishing and updating our audience as we carry on. As you know that there is a lot of disturbance with regards to hosting events. We are still trying to sort out how Windaba will work out, and while we are doing that, we would like an opportunity to keep our Windaba audience engaged, and hence we are having a series of webinars. Thank you very much, Neil. I want to keep it brief because the important message is coming from our speakers.
Great. Thank you, Natombi. That was brilliant. First up, our first speaker for today is Emerson. Emerson, over to you.
Thank you very much, Neil, and thank you very much to Sawaya and everyone that's gone into organizing this important webinar. It's great to keep that drumbeat rolling in anticipation of a Windaba, which is always a great event. So I guess coming from the Global Wind Energy Council, I'd like to sort of frame the discussion on taking a bit more of a global perspective, that sort of feed through to the South African situation. As we know, we're currently in a health crisis, but the economic crisis that was sort of beginning now, we haven't yet seen the full ramifications of, is potentially even more serious and something that must be thought about very strategically, because as we know, the choices that will be made now through various stimulus packages or directions being taken, government decisions, will have lasting effects. So right now is a very important moment for wind and renewable energy and the energy transition. As we know, a lot of processes are being accelerated during this time, and this essentially must be one of them. Another sort of key thing, looking from a bird's eye view, the economy and the environment have never been more closely connected. And I think as a wind industry, we need to, we're very good at getting our messages across in the energy space, but it's really time to break out of the echo chamber, and that's to getting all the way down to energy users and to corporate end users as well. So really bringing that whole ecosystem that wind energy and renewables can provide for into the fore. Greenhouse gases have fallen from more than 2020 than any other year. And we find ourselves in a situation where wind energy in many markets has now reached cost competitive. The investment appetite is there. So from GWEC's perspective, at least, we see the key issues being around enabling environment, regulatory and policy, and political will being one. Just one quick sort of contextual point here. A very interesting study came out by a famous economist, Stiglitz and Stern, recently, that did a study of all the different stimulus packages and its history over the years, and it was the Oxford Review for Economic Policy. And the idea is that a stimulus package and economic recovery that targets clean energy infrastructure, where wind can play a key role, is more likely to create jobs, to restore long-term health to economies, and help to achieve climate goals rather than traditional stimulus methods. And the review of the 2008 recession basically says that we must move beyond these conventional methods. So at GWEC, we have an industry-wide statement that is supported by the largest companies and associations, of which Sawaya is a signatory. I'll go into later, because right now is a time we need to advance the deployment of wind. And South Africa is in a wonderful position. I know that wind is a key contributor of foreign direct investment, and it's got a real sort of fervent young generation that really sees this as its future. And young people are the people are going to have to pay for this economic recovery, so we must have our say. Next slide, please, Neil. So, coming from a global perspective, I just thought I'd run through some interesting things here. This was a global poll from Ipsos Mori, and it asks a fundamental question: how do we turn public consensus, as I mentioned, into global action? And I won't spend too much time on this, but 65%, and a majority in every country that is polled here, wants a green economic recovery. Once again, speaking to the point of how intertwined the environment and climate change is with the economy and its recovery. Next slide, please, Neil. So here, this is a way of framing discussion, and I think taking a step back here is that this is based on our own market intelligence. We expect a 16% drop in new wind install capacity in 2020 due to the disruption to COVID-19. We see a likely bounce back in 2021, but this chart shows what we're sort of up against and really sort of frames the scenario. And the next 2-3 slides actually break this down even further from a baseline growth model. If I go to the next slide, please. So this is the pre-COVID-19 forecast, which was an element of the last one. And this is capitalizing on 19% year-on-year growth in 2019, and big years from China, Europe, and the US. And our growth, as we know, as an industry, is based on market-based mechanisms, auctions, tenders, driving volume. Next one, please. Now here is, and I've put this in red for effect because this is really why action is needed. And it demonstrates that in this do nothing scenario, there's 69.3 gigawatts downgrade due to projects failing to close financing or recessionary impact. And this is due to things like lack of extensions for project commissioning deadlines, feed-in tariffs, heightened investment risk around currency, counterparties, credit lines. So, we see 20% of scheduled capacity abandoned and cumulative new installations declined to 285.7 gigawatts in this do nothing scenario. Obviously, this is not what we're going for, but it's very, very important to keep in mind. The green recovery, which is what we're going for, that was absolutely right, Neil, which we see as a 94.9 gigawatt upside at minimum to achieve climate resilient growth. Now, this is a 27% increase in capacity and new installations in the global transition scenario. This is what we are aiming for, and this is what needs to be the backdrop from a global perspective to economic recovery and the role that wind can play. Next one, please. Now, contextually speaking, we're up against quite a lot, and I just throw some stats out there because the challenge is quite significant. Some of these stats are U.S. specific. They give you an idea that fossil fuels outspend renewables by more than 13 to 1, and really sort of dwarf the sort of lobbying capacity that renewables has. So one of the themes and messages I'd like to get across here is that at GWEC, we work with our partners and associations such as AWEA, and being connected as an industry and really acting as in a unified way is more important than ever because it's an uphill battle and there is immense amounts of money being deployed by the incumbents and fossil fuel generators. And that's not just the US, it's a global phenomenon, unfortunately. Next one, please, Neil. Now, on to, this is essentially a distillation of GWEC's industry statement and its key pillars. I think that there's a link to the full statement, which is housed on GWEC's website that will be put in the chat shortly for those who want to have a more thorough read. But really, the statement is all about continuity and acceleration. As I mentioned before, all the key elements are in place for wind to be a key building block and a cornerstone of economic recovery. And it is essentially one of the world's most promising industries, and this is why it creates a real opportunity to renew critical infrastructure, and without asking for a bailout either. We just need the right conditions and support. So I'll just pull out a couple of key things from these three pillars we see. The no harm principle and evidence-based decision making. This is part and parcel of climate change and carbon reduction across the globe. The other key point here is stem the capital flight from emerging markets, and instead view this as an opportunity, as a bit of a reset to invest in wind and other renewable energy technologies, because that is essentially investing in the future and not the past, and that's a really key thing to keep in mind here. And the enabling environment, and this is where we bring in, we go outside the energy space and really talk about, removing barriers for corporate end users. Not only is this now part of corporate, sustainability guidelines, it is now, it's a lot of times the most efficient and for big major energy users to procure renewable energy power. And on the way to decarbonizing other sectors as well. Next one, please, Neil. Now, I thought that we are seeing some green shoots and some encouraging examples from across the globe, and I tried to pick out some examples that GWEC has been involved in, but also that are geographically diverse. In the USA, despite renewable energy not making it into the first stimulus package, there are important advances being made on the individual state level. You have the state of New York, Virginia, many along the eastern seaboard, essentially upping their climate goals and their renewable energy targets through onshore and offshore wind. So these are happening despite lack of movement on the federal level at the US level, and also the extension of the production tax credit, which is a subsidy for renewable energy. In Poland is an interesting example because of an economy heavily reliant on coal. This kind of relates to the force majeure element, and we've seen the Polish Wind Energy Association urging the Polish government to pass an emergency law to ensure that contracted deadlines are not missed and that projects aren't penalized as a result. We've seen a similar thing in India, a very encouraging early sign where the energy ministry essentially came out and declared force majeure across all contractual agreements and project development milestones to ensure the continuity of the industry. And that continuity and safeguarding and making sure that the current health crisis doesn't do anything to set the wind sector back at all is even more important in inserting us into the discussion around economic recovery. And Vietnam is another important example where we've been working with the government there on the extension of the feed-in tariff in order to bridge the gap towards a potential auction. And as we've seen, the EU green economic recovery deal has been an inspiration for other markets, and we've seen South Korea, which is one of the most notorious largest carbon emitters per capita, propose a Green New Deal in its recent elections and the new government in place. So some encouraging signs there, as well as Chile, who is also a big carbon emitting economy based on forestry and mining, also upping their national climate action plan in line with the Paris Agreement. And so we're seeing some early policy movement here, and this is the beginning of a really important phase for the wind industry. But we feel like we're in good position. The economic case is there, and it's a matter of political will and the enabling environment. And as I said, it's the industry needs to both globally and in country needs to stay as connected as possible, because these messages and the benefits are there. Markets have their own nuances, but this is truly the way forward. So once again, the wind industry needs to come out as a solution-based example, and yeah, it's about investing in the future and not the past, and I'll leave it at that. Thank you so much.
Super. Thank you so much, Emerson. Really appreciate all your efforts. Good to see you. And now, ladies and gentlemen, to address you will be Javier Steyn. Welcome, Javier.
Thank you very much, Neil, and hi to everybody. I'll just wait for the slide to move on. And the next slide. Thank you very much. So I'm going to really much deliver the same type of message that Emerson did, but now focusing on South Africa. And we are going to be showing you, I'm going to be showing you some early results out of a study that we've been working on with the CSIR. And of course, the key message is that the energy sector in South Africa can provide a large green stimulus to lead the South African economic recovery in the post-COVID era. And the reason why this is, of course, is that we know that much of Eskom's generation capacity needs to be retired in the foreseeable future. We all know that renewable energy is now the cheapest source of energy and will be the dominant part of the future development path of the power sector. And these circumstances coming together, particularly in South Africa, with our exceptional resource that we've got here, both in wind and solar, creates the circumstances for a large, sustained, mostly private sector financed investment program. And this, of course, includes projects across the spectrum, small-scale projects, embedded generation, self-supply, third-party suppliers, utility scale, and independent projects, and even possibly Eskom. The key point here, and that's relevant to the theme of today's discussion and relevant to the economic discussions today in South Africa, of course, is that the economic opportunities that this creates, other than ensuring secure power supplies, it creates important opportunities to localize the value chain behind wind and solar generation, reindustrialization for South Africa, large-scale job creation in manufacturing, services, construction, operations, and maintenance, and importantly, a much greater opportunity for much greater participation in the energy sector for previously disadvantaged groups. And also of equal importance, the opportunity to ensure a just transition for workers and communities that would be affected by this change. Next slide, please. I'm still waiting for the slide. Okay, yeah, there you go. So in this slide, we can see the additional capacity being added by the IRP 2019. That's the government's current policy plan for the power sector, and this shows the wind and solar capacity being added in as envisaged by that plan. However, we think it's possible to have a much larger program than that. Next slide, please. This slide shows, and this is based on proper system modeling conducted by the CSIR with us. This is a moderately accelerated renewables program over and above the IRP. And you'll see that most of the early acceleration actually happens with solar PV, and that the wind program picks up over and above the 1.6 gigabyte, 1,600 megawatt limits currently in RP. It takes a while for that to pick up, and I'll get back to that point in the next slide. Next slide, please. This is actually a very interesting scenario. This is an even more accelerated scenario where we see the total capacity being constructed ramping up to about 6,000 megawatts by the second half of this decade. We've just recently completed the industry study that shows with a sustained program that this is indeed possible from a practical point of view. Next slide, please. Right, so it's to come back to this question about when the solar could ramp up further and the wind. You'll be well aware of the grid constraints on our network in South Africa. And the key problem, of course, is that the areas where there's the most interest to build wind and particularly wind projects is not necessarily in the areas where we still have a lot of remaining grid capacity. I'm showing you a slide here from Eskom of a study that was done about 4 years ago. Of course, the picture might have changed a little bit now that there's more knowledge available about the wind resource, particularly in Mpumalanga. But basically, the methodology we followed in this study is that we front-loaded the solar construction ramp up, and to some extent had to wait for the grid to be expanded before you can accelerate the wind over and above the 1,600 megawatt a year rate. Next slide, please. In this slide, there's a lot of information in this slide. This is the results of many scenarios that we ran, system modeling scenarios, and we essentially created two-dimensional space. The horizontal axis is the total system emissions over a 30-year period, and the vertical axis is the total levelized cost for the power sector. The gray line shows the theoretical system adequate line for the frontier, the most efficient way to achieve any one of those points on the gray line. But actually, in reality, we have to, of course, have scenarios that are actually buildable, that are smooth and ramp up smoothly to in the way that I showed you in those previous slides. And that means, we have to tweak the theoretical model scenarios to produce those blue dots that show the actual potentially achievable scenarios. And yes, I mean, I think the relevant one is the second is the IRP, particularly the two right-hand dots that shows the IRP, different interpretations of what the IRP 2019 scenario means in terms of emissions and cost. And then we have a series of more assertive mitigation scenarios, in other words, more aggressive renewable energy scenarios moving towards the left. And the most important, I think, can we have the next slide, please? This is the same information, but now the vertical axis is actually starting at 0. And the most important finding here is actually, even with very aggressive renewables scenarios, it doesn't really cost more than just executing the IRP itself. This is a very important finding. It's possible to save at least 1 gigaton of carbon in that period, and possibly more, and not cost anything more. Next slide, please. So from an economic point of view, of course, the capital invested that's implied by these different programs is important. We're showing you here that for the IRP implies about 245 billion Rand invested over the next 10 years. Next slide, please. The moderately accelerated program adds another billion Rand of investment, capital investment alone over the next 10 years. And then if we have an aggressively accelerated scenario, as we show in the next slide, that number goes up by another 100 billion. So we're talking about almost R500 billion rands of investment that could be achieved maybe in the next 10 or 12 years if we really put this at the top of our agenda. Next slide, please. Of course, the next question is jobs. This slide shows the total new expected created jobs in the renewables industry starting from 2021. This is the IRP scenario. And you see in 10 years' time, at 2030, that goes up to just over 20,000 new jobs. Next slide, please. With a moderately accelerated scenario, next slide, please. Still waiting for the next slide. That would go up to just below 40,000 new renewables jobs. Now compare that to Eskom's current approximately 45,000 jobs in Eskom. So in about 10 years, even with a moderately accelerated scenario, you could almost create a new Eskom worth of jobs. Of course, some jobs will be lost in Eskom, but most of Eskom will still be there. Next slide, please. And then, of course, if you have a really accelerated program, this is just phenomenal. And these are just direct jobs created in the industry, in the construction and operation and maintenance of plant. Next slide, please. Of course, what we're envisaging here, even with the accelerated program at the right-hand curve, the red curve on the right-hand side, would really just be catching up with what many of our peers, as shown in green and blue there on the left-hand side, have already achieved by 2018. So this is completely within the normal range of build-out rates. Next slide, please. Many people in South Africa and abroad are now calling for a green stimulus led by renewable energy. Next slide, please. I'm aware I'm almost at the end of my time. So I think it's important to talk about the fact that renewable developers face many constraints when they develop their projects. We've done a bit of a study of that. Next slide, please. And that a large stimulus will only be achieved as such a large renewables program if we have fundamental policy, regulatory and market reforms in South Africa. So I don't have time to go into it now, but I think we all know that the current way the sector is governed and regulated will not enable us to achieve this kind of economic stimulus. And we have to put this at the top of the agenda. Next slide, please. It's the last slide. So basically, I think a broad range of analysts agree that a large renewables and energy-led green stimulus is one of the few substantial recovery opportunities available to South Africa. Importantly, it doesn't require fiscal resources, but it does require fundamental policy and regulatory reform. In the short term, these reforms can actually be achieved relatively easily by just changing the ministerial regulations. But ultimately, we will need zero-based policy and regulatory and market design to achieve the main benefits that such a stimulus can bring for South Africa. I didn't have time to talk about it today, but there's also the opportunity to leverage such a program to achieve a large climate deal to support our power system. And lastly, of course, even though there will be many challenges to achieve such a program, the biggest challenges lie in our imagination and political will. Thank you very much.
Thank you so much, Kruve, and thank you for sticking to your time. I know that was quite difficult. I just wanted to let everybody know that we've got 190 people that are engaged on the webinar today. We will be sharing the contents of this webinar after this. So I'm sure you're taking notes, but just know that we'll send you all the information you need. And now, ladies and gentlemen, we come to the stage in the webinar where we would like to get your input. I'm going to share a poll with you guys now. Please take the time and complete it, and then I will share the results with you just in a few minutes. You should see the polls now. There you go. So I'm going to give you a few minutes. Please take your time, complete this, and I'll let you know when we're going to end off. Please, please get involved. We don't have anybody that has one person has got involved. Come, we need more than that. 2 people, come on, let's go. Okay, we're getting some of this in now. Going to give you another minute or so just to complete this, and then I'll share the results. Just to let you know as well, while you are completing this, that Natombi is looking at the questions that are coming through, and she is just curating those questions. And at the end of the session today, we will run the Q&A session, and she'll post those questions directly to the speakers. So don't worry, we will get to your questions, and the ones that we can't get to today, we'll try and get to after the webinar itself. Okay, we're up to almost 50% of the votes in. I'm going to give it 1 more minute, and then we're going to share the results with you. So fastest finger wins. Okay, in 5, 4, 3, 2, and 1. We are done, and I'm going to share those results with you now. And there you can see. So first question, fast tracking implementation was the highest. Question 2, pretty even there, but 59% the impact on country's total economic activity. Question 3, also quite a nice even split there, just recovery plan coming out on top. And then 4, some nice topics here. So everybody seems interested in those topics that we've suggested. So hopefully in the next few weeks, we'll be able to share the details of the next webinar. Okay, and now to address you, we've got Marapini Rapelu. He is going to be addressing you now. So over to you, Marabini.
Thank you, Neil, and thank you, Sawea, for organizing. I think there's a lot of talk that we've had, and I'm not going to repeat what has been said. It's quite clear that there's a lot of job creation potential. There's a lot of economic stimulus that that can come from renewable energy. What I wanted to do for us to do is to bring it to a context. We are operating in a world, I'm calling it a whole new world. It's the same world, but it's new rules, I suppose. And what we're doing is we need to be able to operate in this whole new world, but also bring it into a context as to we are operating in South Africa with all its challenges and all its problems. So what has happened in the past, I don't know whether it's 65 days or 70 days, but in the past, since February, essentially, change has happened. It's happened very quickly. We didn't have much of a choice with the change. You know, no one ever thought that the world would shut down for 2 months, but it did. And that's what it is. We've had redefining of essential services. We've got new jobs that are coming up and they're going to be in demand. We're going to have to be innovative. You know, from now on, this is something that has been coming up in the past year, but the view is that it will be accelerated. There's going to be a greater focus on energy efficiency. There's going to be a greater focus on ESG and GRI reporting. The slide that you're seeing, sorry, not the slide, the picture that you're seeing on the left, on the right, sorry, previous slide, please, it's showing you that even though there is change from a renewable energy perspective, the benefits or the gains from the change outweigh the losses. We will lose some of the old industry, but we tend to gain more than we lose. The challenge always is that it's easier to maintain what you have. It's easier to keep what you're doing going. But if we actually look at creating new jobs, new skills, we need to build new things. If you can go to the next slide, skip the next one and then go to the next one. The third slide, skip this one. If you look at this slide, it shows you where these new jobs are going to be coming from. You have wind. You have wind offshore, wind onshore. And then it shows you that most of the jobs are in construction, installation, manufacturing, and then operation and maintenance. That's very important, because what this means is that these are jobs that people can be upskilled for quickly. Education, training, these projects are built in very remote areas, not in urban areas. It creates this economy in those areas. So you can say, you know, construction and installation jobs are not long-term jobs, but if you look at the IRP, integrated program, we're looking at 10 years up to 2030. So you essentially have 10 years of jobs in construction in various areas. If it goes beyond then to 2050, you have construction jobs until then. You look at manufacturing jobs, wind is uniquely positioned for that. We've had wind tower facilities that are open. We have some that are closed. There are examples in Brazil where, you know, with policy certainty, you can do a lot of wind. There's opportunities in transport, operation and maintenance, the cranes, the towers, you know, there's a lot that you can do. But if you look at the bar on the far right, it shows you that the jobs that are created are jobs that essentially are not difficult to train for, sorry. We need workers and technicians, and that's it. That's the main jobs that you're going to create. These are jobs that you can train people for, and you don't need to say, you know, you need a particular level of skill. You can do on-the-job training, and it can create a difference. If you can go to the next slide, please. Next slide, skip that one. What we've also experienced with COVID-19 is that we are very reliant on China, I suppose, in terms of renewable energy and different areas. I think Europe as well, from a manufacturing perspective, and some products do come out of the US. But what we need to then look is at whether our supply chains are sufficiently diversified. We need to ask the question, should we manufacture locally? The short answer for me is yes. Should we designate so that there's stuff that you can't import? To the extent that we can be competitive, yes. Is price everything? We need to ask that question. A lot of our procurement has been focused on price. I think we need to look at where we are competitive, what it is that we can do, and we should be trying to localize those jobs. That's the only way that we're going to create long-term value. We need to boost local manufacturing, and we need to boost resilience, not only for South Africa, but for African economies. And wind has a great potential to create that. If you can go into the next slide. I think this is really the crux of it. Inequality kills. What COVID has done, if you look at the US, they've lost 40 million jobs in 2 months. We haven't even started looking at how many jobs we've lost in South Africa. We've seen the queues. It's always been there. We've always seen, you know, the conditions that some of our citizens live in. And we need to look at whether, as an industry, there's things that we are already doing. Is there more that we can do? Is there a case for a just cause? We need to ask those questions. If you can go to the next slide. That goes beyond just, you know, jobs. It goes to clean air. For your information, the plant on the left, that's the Kendall Power Station. We're worried about, we're protesting about cigarettes and roast chicken at the moment. But if you look at Kendall Power Station, there's some serious emission issues there, and that need to be dealt with. If we could see the same amount of protest for those issues, those are social issues. It goes to healthcare, it goes to social welfare, employment. What do we do? If you can go to the next slide, please. And then also, we also need to operate as living within a context, not only for a country, but using energy as a catalyst for growth. We all know that you're not able to operate without energy. If you want to create jobs, we want to bring industry, we want to bring industrialization, energy is the catalyst for that. But what we need to do, I think, as a country and as an association and as an industry, is that we need to look at the complete value chain. And we don't look at that only as, what is the wind value chain, but we also need to bring it into, we have an integrated energy plan that sits above the IRP, and that tells you what the energy plans are. These are not just about electrification, it's about energy, not for electricity only, but for heating, for cooking, etc. What we need to do then is that say, how do we bring that into the context? And we do have a very good document, which is the National Development Plan. How do we, as an industry, go into implementing what is required there, but also keeping our business going? So what we need to do then is to look at energy security and energy and economic development. You can't have economic development without energy security. You can't have energy security without economic development. They are linked. We need to look at job gains, transforming energy investments, and also look at what else can we do from an electrification perspective, but from an energy perspective. So on the right there, you look at the interventions that can come in from a renewable energy perspective, the interventions in road freight, aviation, shipping, manufacturing, iron and steel, chemicals, petrochemicals. There's a lot of talk at the moment around the hydrogen economy. How can we participate in that? How can we enable that? I think the main crux of my discussion is to say we need to be part of the solution. We need to know the context that we're operating in, and we need to offer solutions. Thank you.
Neil, you are talking on mute.
There we go. So our next speaker is going to be Dr. Tobias Bishop-Nims. He's the Head of Department Business Development for Enetrag. He's going to share his screen. So I am going to stop my share, and there you go.
Yep. There we go. Thank you very much. Thank you for, I hope I'm not muted now. Can you hear me?
We can hear you, Tobias.
Okay, perfect. Just wasn't sure whether I'm muted or not. Okay, great. Thank you very much. Thanks for the speakers. Thanks, Neil, and Tommy for organizing it. In the same way as my previous speakers, I want to highlight what the wind investments opportunities for South Africa's recovery are, and the green hydrogen topic, which the previous speaker mentioned a lot. I want to highlight that as well, how that could be linked to recovery packages elsewhere, because I believe the more we link recovery packages globally, the more bang we will get for every euro or dollar or rand or whatever the currency is that we spend on recovery. So, but first, let's have a look at what happened globally so far. So we, as in wind industry, we are fully prepared, we are fully industrialized, have reached industrial scale for the last 10 years, deployed many dozens of gigawatts every year in the pre-corona world, 60 gigawatt alone last year. And now we have in terms of post-corona plans and announcements, we have an increasing number of governments, organizations either announcing or calling for making green projects significant part of the New Deal and the new recovery in the post-corona world. And I think that makes a lot of sense, especially for South Africa, where we are in a situation where the existing fossil-based infrastructure is basically coming to a point where it's in natural decline through simple natural attrition, because the average age of the Eskom coal fleet is getting close to 40 years now, and so we have to build something new anyway. And we can, that necessity for building new stuff, we can directly link that with a Green Deal recovery plan, because it's the right thing to invest in today, and the right long-term investment anyway. So that is a good link to be made. If we look back at what happened in South Africa so far in terms of investments and the effect on employment and tariffs, then we see that since 2013, we had implementation of about 3 gigawatt of wind in South Africa, or by end of 21, we will have 3.3 gigawatt roughly. And we had a number of very positive resulting economic effects from that already. We had about 80 billion investments in basically 5 years between 2013 and 2017. We have, as we speak today, not job years or not future jobs that we might want to have or that we predict to have. We have, as we speak today, roughly 8,000 jobs in construction operations of South African wind farms. We have 6,500 jobs in construction as we speak of the round 5 projects that are under construction. Round 4, of course, and we have about 1,500 permanent jobs in operations as of today in the South African wind fleet. So that in itself is a very significant contributor to jobs, if we keep in mind that Eskom as a whole, yes, has 40,000 jobs, but Eskom generation, which is the right comparison, has only 12 to 13,000 jobs. So renewables are clearly more job intensive per energy output than coal-based, and we can and should leverage that to address challenges that go beyond the electricity sector in South Africa. The tariffs that we have seen, huge decline, 60% decline in just 5 auction rounds within 4 years. We expect, if and when a new auction comes in 20 or in 21, they expect anything between 40 to 60 cents. I made a broad enough range to not be in conflict with anything, but I think it's fair to say that this is the range that we are expecting in today's money. So another significant decline over already cheap tariffs from 5 years ago. And now what is now important to note is, what does that mean? If we expect 40 to 60 cents per kilowatt hour, we are now with new wind in the same cost range as burning coal in an existing coal plant. The average Eskom coal fuel cost, as per Eskom's latest financial reports, is 37 cents in today's money on average, which means there are a number of coal stations that have much higher cost than 37 cents. If you add to that CO2 cost at very modest 120 rand per ton and the environmental levy, then the pure variable cost of burning coal fuel in Eskom today is already higher than building an entirely new wind farm. So in such a situation, you literally cannot overbuild anymore, because the cost that you spend on wind tariffs is the same, if not less, as the cost that you spend on burning coal. Therefore, if we look at the IRP, yes, it's a plan that sees a lot of wind investment already. We've heard that from previous speakers. 1.6 gigawatt per year is planned as per the IRP 2019. A substantial rollout. First one in 22. So if we want that to happen, we have to start sometime soon. But I think what is good about this plan is that the rollout is very predictable and constant, which will lead to a number of positive effects. One is, if rolled out this way, we will have between 300 to 400 billion total investment until 2030. We will have 25,000 jobs in construction operations by 2030, and they will become permanent as we continue to roll out with this 1.6 gigawatt. And we have a significant chance for manufacturing establishment. I say we have a chance because 1.6 gigawatt per year is great, but it's not that this is the most attractive one from a supply chain and manufacturing based perspective. Plus, of course, on a side note almost, we get very low cost electricity to stimulate the economy beyond the electricity sector. But if we are doubling down as a corona response recovery on the IRP 2019, basically bringing forward all the capacity that we have to build beyond 2030 anyway, because beyond 2030, that's when the real decommissioning of the Eskom coal fleet will kick in. So there's a lot of new capacity that has to be built anyway. If we bring that forward and build double, roughly 3 gigawatt per year in the next decade, then we will have resulting economic effects of 600 to 800 billion of total investment, which is investment that is future directed, and it's investment into something that is needed anyway. It's not something, it's not an expense in that sense. An investment is only an expense if you invest into not needed things. We will have 50,000 jobs in construction operations by 2030, and we will have very significant potential for local manufacturing with export potential of components into the region and into the global supply chain of wind components. One link I would like to make to the green hydrogen topic, because everything that we discuss here is purely looking at the South African electricity sector. But if we think beyond electricity, if we think beyond just supplying the South African electricity demand, if we think in terms of beneficiating wind into electricity and into green hydrogen, that can then be an export product into the rest of the world, where South Africa is in a advantaged position because of better wind and solar resources than many other countries, then if we want South Africa to become such an exporter of green hydrogen rich products, then we would need in the long run, not the 100 gigawatt that we need in the long run for the electricity sector only of wind, we would need 200 gigawatt of wind to not only supply the South African electricity demand, but to also produce the export products that come in form of green steel, green ammonia, green aviation fuel. And that is a conservative estimate, actually, the 200 gigawatt. So if we want to reach that, we would have to build from the 2030s onwards 10 gigawatt per year to reach the 200 gigawatt, which then comes at 10 gigawatt in perpetuity, because you have to start rebuilding the initial wind farms once you reach the end of life. So the foundation for that, that's more the medium-term game, but the foundation for that can be set today, can be laid today through a Corona-linked response. And the question that I would ask is that a way to link the recovery packages in Europe with the recovery response in South Africa by potentially Europe? So Europe wants green hydrogen, and it wants affordable green hydrogen. And South Africa is in a prime position to produce that green hydrogen. So I think there's definitely potential, if there's such a tradable product in between, to link the two recovery packages. As a result, we would have 200 gigawatt of wind by 2050. And you see, I like to play the ball forward. So you see, we are going beyond what's happening in the next decade. Yeah? We would have 10 gigawatt of new wind installations per year in perpetuity, which is a significant construction sector on its own. It would mean 200,000 permanent jobs, 100,000 in the operation of the 200 gigawatt fleet, and another 100,000 in the construction of the 10 gigawatt per year in perpetuity. And we would produce 7 million tons of green hydrogen that we could export, that would have an export value of anything between 20 to 30 billion, depending on what exactly it is that we export. So I think that's the vision that we should have in mind, and that we should be guided by when talking about recovery packages for Corona. With that, I would like to thank you. Exactly, but I'm just summarizing, and thank you very much for your attention.
Thank you so much, Tobias. If you can just stop your screen share, that would be great. Ladies and gentlemen, we're going now to a short question and answer session, which is going to be hosted by Natombi. So over to you, Natombi.
Thanks, Neil. I've got a couple of questions, and I'm also aware that Emerson needs to get out as soon as I think in the next 10 minutes, so we'll release him whenever he needs to go. First question, I think it's for Marubeni. It's Greg Shaw, who was asking if is this new job creation or the conversion of fossil fuel-based jobs opportunities to renewable energy ones. So basically, are we adding new jobs to the economy, or are we just converting one job opportunity to another? I think that was based on Marubeni's presentation. And can I ask the panelists to please keep your answers as brief as possible?
I think we're getting technical. I think we need to look at, we are creating jobs. If it's a job that's replacing an existing job, or if it's a new job, we should be looking at how many jobs are we creating, how many people are we keeping employed, and if we're looking at the IRP up to 2030. And if you're looking at what Dr. Tobias said into 2050, you're looking at those jobs over a very long time. So those are sustainable jobs, and those are jobs that we should be looking to create.
Okay, maybe if there's a follow-up question from Cyril Magwaza. He wants to understand how will 4IR and BIM implementation have impacts on job creation for countries like South Africa, which are left behind. And this can be posed to any panelist, because I'm not sure if you touched on that in your presentation, Marubini.
I think I'll invite other people to come in, but I think simply put, we don't need to look at wind as in isolation. I think one of the slides that I showed was where the jobs are created. And there's a slide in there as well, which says, we need to look at ourselves as part of an industry. I think wind, renewable energy, integrating it into a grid, etc., requires various technologies, and you need artificial learning, all those things. Those are things that can come in, and those are all opportunities where we can learn at the same time as other countries. So we are a bit behind, but we can catch up very quickly.
Thanks, Marubini. I think Rove wants to add to that.
Yes, thank you. I mean, I think it might be possible to be a bit more specific about the jobs issue. But basically, of course, we are going to be losing jobs in coal mining and also in Eskom generation. But it's important to remember that people throw around the numbers such as about 80,000 employees in the coal mining sector. But of course, not all of that coal goes to Eskom, right? Only about 120 million tons a year goes to Eskom. And of course, not all of that coal is going to be stopped. We're not going to stop burning that coal overnight. It's going to take a couple of decades to get to that point. So actually, and that's only in the generation side. So, and then of course, as Tobias has already referred to the employees in generation, but I think the bottom line here is there's going to be some job losses over time in Eskom generation and in coal mining. However, that will be replaced with many more jobs in renewable construction and operations. And the construction will continue in perpetuity. I mean, that's also clear from Tobias's presentation and from mine. So the net position is that we are going to be creating many more jobs than we currently have in the electricity generation sector. And then I haven't even spoken about the expansion of the transmission grid and the distribution.
All right. Thanks. I'd like to move on to the other questions. There's a question from Langa Tibini. He's asking that given the positive and reassuring posture of the authorities in the countries like India, Vietnam, Poland, US, what are the short to medium term implications of Eskom's decision to invoke the force majeure contractual provision during the month of March? And secondly, what sentiments does this action paint of the South African regulatory environment? This is a general question for all panelists. I won't direct it to one particular person. Or I can put Tobias on the spot.
Yeah, I'm happy to take that question. Well, I think for wind or for any renewables investment, whether it's wind or solar, we have to look at the specific cost structure of these investments. And the cost structure is completely fixed. Once you've built it, you have basically no running costs. Your O&M cost is all fixed, irrespective of how much you produce. So you have a certain annual cost per year, and over 20 years, you're completely locked in. And because we have high certainty, we have an agreement upfront in terms of who takes what risks. Because of that agreement, and the risk allocation is such that the owner of the wind farm takes the risk that the owner of the wind farm can control and manage. That is always a good way of allocating risks. Because of that, we are able to finance on long-term terms these assets at pretty, well, they could be better, but it's still at already quite good terms. That's one of the reasons why the tariffs are so low. If you introduce risks into such a 20-year investment, then it will still be invested, but the tariffs will be higher. If you ask someone to take a risk that this someone cannot manage or control, then yes, people will still do it. It's a different type of investor then, take more risk. The bank will give less money. It's more equity investment, and the tariff goes up. That is no problem. The real issue is that if we change the rules of the game after we have made the contract and after we have made an agreement for the 20 years, that's the real issue. That's almost a bigger issue than defining rules of the game upfront that are different to what we have today.
All right, thank you, Tobias. Second question from Tsepo Manotsi. How is the wind industry in SA going to ensure that locality doesn't provide other technicians and SMEs? So it doesn't deprive other technicians and SMEs. So locality, I think maybe locality of employing people within a project location instead of opening opportunities for the rest of the country. I'm going to go through a couple of questions and then I'm going to split them amongst the panelists. We also have a question from Nicolette Pomofanzel asking, local manufacturing is where many job opportunities will be created. How can the local wind energy market make an impact in this regard? And what must government do to take advanced manufacturing?
So maybe just the first point, at least the job numbers that I showed, I'm not sure about Javier, but my job numbers are not based on significant local manufacturing. They are based on construction and on operations, basically very much aligned to the REAP type of jobs that we already have and have seen today. So in that sense, the jobs numbers that I have shown are the lower bound. If there's additional manufacturing jobs, that's an add-on and another positive. Yeah. So in the manufacturing space, I think we should try to get local manufacturing of wind into South Africa for sure. From a jobs perspective, this is actually not where most of the jobs are created. Most of the jobs are in construction, second in operations, and only third is in manufacturing. You see that in other manufacturing countries for wind as well. But that being said, there are many other reasons apart from jobs why local manufacturing makes sense. It creates a certain ecosystem and so on. And can South Africa do that? Yes, of course it can. It's big enough. It has the required supply chains. Literally, the only thing that is needed is certainty around the rollout of the South African market itself. Because without that certainty, no manufacturing company will set up a shop for many hundreds of millions of euros of manufacturing capacity if there's no anchor demand that is somehow clear and certain. And we're not talking 20-year certainty, but at least 6-7 year certainties into the future. All
right. I also have a very good question. Thanks, Tobias. I also have a very good question from Nyasha Horonga, who's asking that Eskom has highlighted stability concerns around RE penetration. How is this concern going to be addressed, especially as we continue to connect more RE projects? Can I give this to Rovi?
Well, I'll give it a quick bash. I had a chat with some Eskom people about that exact question about yesterday. I think there are real concerns around grid capacity, etc. And therefore, in our modeling, we assumed it takes, that the ability to connect wind projects is constrained to some extent if you want an accelerated program above the IRP in the early years, but that one should, but that the system will respond, but there will be a lag. So that's the grid part of the question. And then system stability, which is more around, system adequacy and keeping the system in balance on the short term. I think that's just more a question of adding the other resources that you'll need, whether that's gas turbine capacity, battery storage, converting old power stations into spinning synchronous condensers, etc. And so one will have to model those costs, but that is likely to be a small fraction of the cost, and is not likely to change the least cost path, which will be renewable. So in a nutshell, if you give engineers a problem, they will solve it.
Tommy, you are muted.
Thanks, Tobias. I'll just read one last question. I'm aware that we are a bit over our time. Last question would be from Maloba Tetla. Should we even get into position where jobs from RE are being lined up against jobs lost to coal? Is that a reasonable approach to economic contribution, or should the discussion be around the contribution to job creation by RE as part of a larger economic drive to create jobs in the SA economy, given the job crisis as well as the need to convert the economy away from fossil fuels? So that's not really a question, it's a contribution. And I have noted all the questions, and what we will do, we will be responding via email to all the people who have posed the questions. Unfortunately, we have run out of time and I have to hand over to Neil. Thank you very much.
Thank you very much.
Thank you, everybody.
Just to everybody, a big thank you for attending the Windaba webinar. We hope it imparted some knowledge and answered a few of your questions. As mentioned now, we'll try and get to some of those questions and get in touch with you. But we will also share a recording of this webinar with everybody, so you can go back and just listen again if you wanted to just answer one or two questions that you weren't too sure of. So thank you, everybody, and look out for the next webinar. We'll be marketing that shortly.
Thank you.
Thank
Bye-bye.
you.
Thank you.
Guys, well done.
Awesome. Great conversation. Thank you guys for your contributions. Thank you so much.
Thank you, everybody.
Thank you for inviting me.
Thanks for organizing it.
All right.
Thank you.
Great.
Take care.
Bye.
Bye-bye.
Bye.